Hi, I'm Rick Kaler. Thanks for joining me. Keep your hands away from your investments and back away from the market reports. That pretty much sums up passive investing, the approach I've practiced for years. I've also preached it for years and did so in a recent column. The wisest way to build wealth is by investing in a variety of asset classes, setting target allocations for each asset class, and then taking your hands off except to periodically rebalance to the original target allocations. Now, for most of us, the best way to invest in an asset class is to give our funds to a mutual fund manager who will purchase the appropriate investments in that class. Mutual fund managers have a choice of actively or passively managing the money that you give them to invest. Passive managers try to match market indexes, which are groups of companies representing a cross-section of the certain type of investment or asset class. The most popular index in the world is probably the S&P 500 index, which consists of the largest 500 companies in the United States. Another popular index is the Dow Jones Industrial Index, which is made up of 30 companies. Now, when you consider that the U.S. has almost 10,000 companies, we quickly see that many indexes represent just a small fraction of the entire market. Research indicates that it's really hard to beat an index, especially with stocks, bonds, real estate, and commodities. I prefer to keep about 80% of my investment portfolio in a broad variety of passively managed investments within those asset classes. So where do I put the other 20%? Well, in mutual funds with active managers who try to earn returns similar to stocks and bonds that are not correlated to either. Now, this may seem to make me a hypocrite. I've been saying for years not to be a market timer. And now here I am suggesting that you do just the opposite with a portion of your portfolio. Well, I'm not being hypocritical at all. What I've preached for many years is that neither you nor I have any business timing investments. That doesn't mean no one should ever do it. It can be wise to put a small portion of our portfolios into various investment strategies with managers who are very active. Active is another way of saying a timer. The key is to find managers who have a disciplined approach that eliminates emotion in the process, and with those managers that have a long-term track record of success. These strategies include managers who attempt to time the markets by shorting stocks that they think will decline in value and buying stocks they think will rise. It also includes one investment strategy, managed futures, that I call timing on steroids. My reason for including some actively managed funds is to have part of my investment portfolio that is not correlated to stocks. I want these investments to have a positive return over a long period, but also to move in opposition to other major asset classes, especially stocks. So when stocks are up, I'm not fazed if my managed futures are down. And when stocks are down, I am thankful when my managed futures are up. And if both of those asset classes earn 6 to 9% over a long period of time, I'm as happy as a clam. So I stand by my commitment to passive investing. It's based on research suggesting that timing the markets is a loser's game. Yet passive investing includes having a fully diversified portfolio. This includes having a small portion, and in my case I'm suggesting 20% or less, in mutual funds with disciplined, successful, active managers. My job is to research and find those managers. Then it's okay to let them time their hearts out. I just make sure that I don't try to time the timers. And I suggest that you don't either. Thanks for joining me.